Central Bank of Malta, and we're very happy to welcome you all to the latest in the series of library lectures. This morning I was watching a video on Facebook posted by one of a leading comedian where he pretended that he was sitting down with a fortune teller in June 2019, and the fortune teller was telling him all about the things that would happen in 2020, with his birthday being cancelled, his job being probably cancelled completely, and where the greatest thing to look forward to was an outing to the garden centre. Could we possibly have anticipated where we were going to be in 2020? Of course, some of the impacts of COVID-19 are going to be temporary, but some of them will be permanent, and they won't necessarily all be bad. Today with us, we are very happy to have John Cassar, and I will allow my colleague Emmanuel Kakia to introduce him, but let's try and understand a little bit about what is going to happen with regard to banking and the consumer and retail changes that will happen post-COVID. The lecture will also be an opportunity for John Cassar to pass on his reflections in honour of John Consiglio, a banker who has been a stalwart supporter of the Central Bank of Malta. He gave a lecture on the history of banking last December, and he also recently donated a few dozen books to the library. While we're on the theme of the library, can I pass you on to Emmanuel Kakia, our librarian, who will introduce our speaker. Manuel, are you there?
Good morning to you. It is my pleasure to introduce you to Mr. John Cassar, who is the chairman of the Malta Fiscal Advisory Council and of the Supervisory Board of the Malta Development Bank. Mr. Cassar worked with a local bank for almost 40 years, serving for a number of years as its chairman. He is also a board member of several regulated companies. Today, Mr. Cassar will draw on his decades of banking experience to provide critically insightful replies to a question that many are asking. What could be the future of retail banking after COVID-19? To do so, he will also showcase some of the important work done by banking historian John Consiglio in his recently published books, Insights on Financial Services Regulation. Mr. Cassar himself has recently reviewed Mr. Consiglio's book that analyzes developments in the regulatory sector.
So let's have a look now at what we can expect from John Cassar, who has been introduced. But before, if I can just go through the normal housekeeping things. First of all, this webinar is being recorded and it will be available on our website shortly after the end of the webinar. We would ask you all to have your microphones on mute as usual. We will be, after the presentation by Mr. Cassar, we will have a question and answer session, and you can either raise your hand in Teams or just send a message on the chat, either passing on your message or saying that you've got an intervention you would like to make. We're hoping to have about 15 to 20 minutes for questions and answers, and I hope that you'll keep us all very busy. Otherwise, I'm going to have to work much harder than I intended. So if I can pass you on to John Cassar now. John, would you like to make an introduction, or shall we go straight to your PowerPoint?
Yes, I will make a brief introduction. First of all, I would like to thank the Central Bank for inviting me to deliver this lecture. And I also thank all those who have booked to follow this presentation. As you know from the title of this presentation is also meant to commemorate the long career of John Consiglio. John Consiglio joined the banking profession in 1958, so that gives him 62 years of experience. He is probably the longest serving banker in the sense that he is still active in the banking sector. John started his career, in fact, as an educator. And I think this love for education never left him because even in his banking career, he dedicated a lot of energy and commitment to the teaching of students at every level, both in internal courses organized by the bank where he worked and also now at university. So John must have seen a whole range of changes that have taken place in the banking profession in these last 60 years. In fact, I can confirm that in the last 10 years, I have experienced far more changes in regulation, especially in banking, than in the previous 30 years. And I'm sure that John can confirm this. John worked in various sectors in the banking profession, from branch banking, which is the most traditional banking, to education within the bank where he worked. He initially joined Barclays Bank, and then this became Midland Bank, and eventually it became HSBC. And John always had a very strong commitment to education, even when he was involved in the Institute of Bankers. I can remember distinctly attending meetings where he always harped on the importance of young bankers training and continuing to improve their skills in banking. John's most recent development in banking was in regulation. As many of you may know, he was one of the governors of the Malta Financial Services Authority. And as I have said, in the last 10 years, there were very many changes in this sector following the financial crisis of 2008, where, rightly or wrongly, the focus of regulation was on banks and the need for banks to upgrade their business models in order to ensure that we wouldn't face another meltdown as we did in 2008. Now John is very active in the education sector. He is a lecturer at university. And as Vanessa said, he recently published a book called Insights on Financial Services Regulation. This is a very interesting book because it deals with regulation from perspectives which are not very common. Regulatory contributions, academia, usually focus on technical issues. However, John looked at the different aspects. It's not a very long book. It is a rather short, 8 chapters, but they are full of thought-provoking comments made by John, built on his experience of how regulation is evolving. He speaks, for instance, about public interest elements in regulation. Public interest is increasingly becoming a top concern for regulators. Information asymmetry, the economist regulator role of regulators, and we know how closely linked regulation is with the economy. The teaching of regulation at tertiary level, and this is an increasingly important subject, because it's no use knowing the nuts and bolts of banking without having a clear understanding of regulation and where regulation is going. And then there was the real world environment in which regulation operates. In these last few years, and even now, we are seeing central banks and financial services regulators getting more involved in the real world, where the economy and banks are joined. There's a strong umbilical cord between the banking sector and regulation. So I hope that gives you a flavor of what John's career was all about. I think that the banking industry in Malta owes him a lot of thanks for the contributions he's made over the more than 60 years of his career. I will now pass on to the actual presentation that I intend to make. This presentation will be split up in 4 sections. I will first look at the impact of COVID on consumer behavior. At the moment, there are many studies being undertaken to see how this big change in our lives is going to reflect itself in future economic activity and also obviously in the habits of consumers with regards to their bankers. The second part will be about how banks can best address the changes in behavior. And let me make it clear that it is not just COVID that is going to determine the future of banking, but it will also be the many outstanding issues that have been written upon in academia and also in publications in these last 10 years. The banking sector has to upgrade the way it does business. The third part will be changes that may be needed in banks' business models. As we shall see in a moment, bank business models have remained static for a very long time until about 10 years ago, when all of a sudden big changes were happening, both as a result of technological advances and communication advances, but also as a result of new competition entering the market, and also because of some crisis that erupted as a result of the 2008 financial crisis. Then I will look at the changes in banking regulation that I and many others who are observers of this sector are seeing on the horizon. It's what kind of changes can we expect? So there are at the moment a number of studies being carried out, and it's very interesting how many of these studies are converging in agreeing on the likely changes. Let me start with a comment that nobody really knows when this crisis will be over. I mean the medical crisis, which then affects the economic crisis and also obviously the banking sector. So there is an element of speculation, I would say. But as Vanessa said in the beginning, there will be changes. Even if the crisis resolves by the end of this year, which is the most optimistic forecast, or the middle of next year, which is a more realistic, probably, projection, there will be changes. And these changes are not just because of the onset of the pandemic, but also because of trends that were developing in this last decade. A study carried by the American Bankers Association earlier this year came up with these conclusions, among others. First of all, there is an increasing number of consumers working from home. And there is a lot of debate going on whether this is going to develop into a permanent trend or whether it is just a temporary trend until the crisis is over. I think that working from home will become an important element of how businesses work, especially service industries. I have read recently, for instance, that even Amazon is considering giving its employees the possibility of working from home whenever this is feasible and possible. So I don't think that banks can continue to have massive offices where they accommodate all their staff. And I think that it should become a permanent feature to see some workers, especially middle office workers and back office workers, possibly working from home. The second conclusion of the American Bankers Association is that the gig economy keeps growing. Of course, there are pros and cons when one evaluates the effect of the gig economy on the economic life and also on the social life in different countries. It is a reality that is happening all around us. And I think this has implications where before people looked forward to having a stable job and they moved from one job to the other when there were opportunities. I think now more people are working on their own steam and getting paid when they work. And obviously this is changing the mindset, especially of younger people, at the way they look at their careers. One of the worrying things is, of course, that the wealth gap continues to widen. This has implications because society in general, at least in the Western world, was rather homogeneous in the past several decades, at least for 4 decades since after the Second World War. We are now seeing a gap widening between the has political implications, of course, and I think that I would be correct in saying that one of the rise in populist politics in this last decade has been a result of people feeling that the new economy has not taken care of them as much as it should have, and therefore they are disillusioned with traditional politicians, and they are supporting the populist parties with very often not understanding whether they are in a position to bring about the change that they would like to have in their lives. It's another reality that adults are waiting longer to start families, and this has implications. There was a time when people completed their studies, then took their first job, and then after a few years, they used to get married. This social pattern has changed, and this has implications on the way that banking is relevant to these people, and in what areas it is relevant. Wellness is the new status symbol. I think we have all realized how important our health is, and I think that in future we will be focusing much more on the importance of our health and pursuing activities that promote wellness. And it's an equally important issue that we are all beginning to get concerned about our environment. This is not just about climate change. It is about the urban environment we live in and pollution. And I think that businesses are increasingly taking note of this issue, which up to a few years ago was never one of the concerns that strategists in banking and in the economy in general gave much importance to. This will become a very important issue. The next slide is taken from a study by Accenture about consumer behavior, and they try to identify what consumers are afraid of after COVID and during COVID, of course. There are issues of a personal concern. We are all very worried about not getting infected, of course, but if we look even deeper, we can identify societal concerns. So the top concerns on a personal level, according to this research, is that many people fear for their health, and therefore they do not, or most of them at least, do not take the kind of risks that they used to take before we realized how serious this pandemic was to our health. From a personal perspective, and this follows obviously from the impact that the COVID has had on the economy, 64% are worried about the impact of the pandemic on their job security. We are all seeing how many businesses are struggling, and even with the health and safety nets that are providing, nobody really knows for how long these safety nets will be available, and whether some businesses will actually continue to have a future after the pandemic is over, hopefully sometime next year. On a societal level, obviously, a healthy society inspires confidence in people, and with all the sad news we keep hearing locally and also internationally about the number of infected people and the consequences of these infections on our health system and the pressures it's putting on the health system, obviously people are worried about the health of the nation in general. And the economy obviously is important for everyone. Even those who have a steady job, which guarantees them steady income, are worried that in the long term, if the economy doesn't recuperate, then they will eventually also be affected. The next slide is about the possible changes in consumer behavior. As I said, there are a number of studies. This is from Ernst & Young, who were trying to project the changes that they expect and that they are beginning to see evolving in the way that consumers are changing their behavior. Here, of course, the picture is broader than that of banking consumers. So here we are looking at a higher propensity to save for a rainy day. I think we are just exiting a stage where consumerism was the most popular philosophy, especially of young people. People of my generation and those before us know how we and our parents feared for our future and always tried to put aside some money for a rainy day. And I think this value is beginning to become more popular, as many people have found themselves with their backs against the wall. And although governments are doing their best to ease the pressure, their resources are not infinite. And I think most sensible people realize that the more they save out of their disposable income, the better peace of mind they will have for the future. There will also be a shift to value and essentials. I think that as a comment that I have just made about consumerism, there was a time when spending was the ambition of most people. And now I think that we are beginning to realize that rather than consume more, we should be saving more, and we should be using the money that we have in excess of our daily requirements to invest in essentials. Flights to digital and multi-channel delivery. I must say that this is a trend that predated COVID. We are increasingly seeing digital services being applied. Those of us who traveled, especially before the pandemic, know that even checking in airports now, many airports, is done on digital equipment. There is, of course, a cultural shock, especially for older people, but I don't think that this trend will be reversed anytime soon. If anything, I think COVID has accelerated this trend for businesses, and here I would emphasize, including financial services industries, need to beef up their investment in multi-channel delivery. The physical delivery channels will still be important, but I think they will start to decline. There is also shock to loyalty, and I think this is a very important issue. I think in the banking industry, our inertia used to protect banks from being daring and making an extra effort to make sure that they deserve the trust that their clients placed in them. I think that people are increasingly losing the sense of loyalty, and they pick and choose who do they buy services from, depending on the quality of service that they give them and on the speed of delivery. So I think that customer focus is becoming a reality. I think in the past, we paid a lot of lip service to customer service. I think now it either becomes one of our acts of faith in our future, or else we will suffer as a profession. Focus on health and caring economy. I think that there will be some economic activities which will not be as badly as affected by the pandemic as others. For instance, the airlines industry and tourism sectors, as we know, throughout the world have been affected very severely. I think there are other industries which will benefit, and I think health and caring economy will be one of them. I think we all realize the importance of taking care of our health, and taking care also of the health of the sector of society. And we all have relatives who are part of that sector who need more care as a result of the threats to our health that we have evidenced in this pandemic. Consumers are prepared to spend more to be prepared for the future. And therefore, I think that there will be a degree of sobriety that will be in the mindset of people who are planning about their future. This applies for all generations, and I think that we are going to see consumers more concerned about the way they plan the future. Clients expect their banks to be more flexible. Banks have in my opinion, have a credibility issue with regards to the way that they are perceived by many of their clients. I think that as an industry, we need to work more to make sure that we really are satisfying our customers' needs and not be as rigid as we possibly have been in the last few years, where we take our customer base for granted. We move on to the next slide. PricewaterhouseCoopers has conducted a survey among bankers. This is an international survey to determine what are the 4 top concerns. This is interesting because, as Vanessa said, this time last year, we were all trying to project what 2020 would look like. And I have so far not seen one model which was predicting the pandemic. There are some who say, yes, there were some writers who did mention that there was a risk of a major collapse in the economy as a result of a serious medical issue. But this was not mainstream. So in a moment we shall be seeing the risks that we were envisaging last year on the risk map that was prepared by the European Central Bank, and what the concerns of bankers are today. First of all, there's the financial impact, including effects on results of operations, future periods, and liquidity and capital resources. Banks are caught in a vice. Many banks were being instructed by the regulators that they needed to revamp their business models. They needed to strengthen their capital. They needed to make sure that they had sufficient liquidity resources before the pandemic. I think these problems have not gone away. These challenges have not gone away, and if anything, they have become even more serious. Especially the operations of banks is unlikely to return to the way it was before the pandemic, because we have realized, as we shall see in a moment, how severe the operations of banks have been affected. The potential of a global recession is now so obvious, and I have seen a study. Let's talk about banking first. This morning I saw a study which is predicting that Western international banks are expecting to either register zero profit before tax, or at best a 50% drop in profit before tax. This, of course, is a result of various factors. Probably there will be an increase in doubtful debts, because businesses may no longer be viable and will be unable to repay their commitments, and also because obviously trade has been affected, and it will continue to be affected at least for the coming year. The prolonged low interest rate scenario is something we were living with in the last 10 years. It is not making life any easier for banks. We know that the projections are that this scenario will continue for at least the next 2 to 3 years, possibly even more. And this has various implications. It has implications on banks because obviously it reduces their margins, but it also has implications on banks' clients, investors who may be tempted to go in for riskier investments in search of yield, because obviously putting money in a bank is no longer giving them the kind of return that they expect and they probably need. The effect of our workforce reduction and productivity. As we said earlier, working from home may become the norm, and I think we have to look at this from different perspectives. From a health perspective, it is obviously the most prudent thing that we can promote, but it means also that the relationship that workers had with their managers, their supervisors, will have to change, and we have to find new metrics and new enablers to make sure that people who work from home are continuing to be productive for the good of the company they work for. Decreasing consumer confidence, reducing consumption. Obviously, when consumers feel depressed because they either fear for their jobs, or they fear for their health, or they fear in general about an economic downturn, this will have a cascading effect on other businesses, and invariably this hits the banking industry. We move on to the next slide. Here is a confirmation of how the International Monetary Fund is predicting, and this conforms with the findings of the studies that we have seen, is predicting the way that consumers will be affected. There will be lasting damage to living standards. This was from the Financial Times Online of last week. So we have to be very realistic. It's not a question of being optimistic or pessimistic or speculating. It is what at the moment we can see happening or likely to happen. This is the risk map that the European Central Bank published in 2019, which highlights what they were seeing as the biggest challenges for banks and also obviously for regulation. And you will notice that economic, political, and debt sustainability challenges in the European area. Of course, the European area has been particularly saddled with challenges. The economic growth in the area has not been encouraging at all in these last 10 years, especially in the southern Mediterranean states, Greece, Italy, France. Political instability is always a risk, especially with the growth of populist parties, which can sometimes create problems for political stability. And very important, I think, we are referring here to sovereign debt sustainability. We now know that obviously central banks have committed themselves to helping both sovereign states that are facing difficulties in servicing their debts by committing themselves to buy as much of their debt as is necessary. What worries me a little is the commitment also to buy sub-investment grade corporate debt. It is understandable that in a pandemic, the last thing we need is for even marginal corporate activities go out of business. But there must be an exit route in this, because otherwise it will encourage moral hazard, which we will have to deal with in the next few years. The business model sustainability, as I said, was and still is a big challenge. If anything, I think it has become more challenging, especially for those banks that still have a weak delivery, IT delivery channel. So I think these banks will be facing additional problems. Of course, with increased investment in IT and communications technology, we will have to be very careful about cybercrime. We have had experiences throughout these last couple of years of cybercrime affecting a number of banks, and I think this has to be one of the top concerns, not only of the leaders of the banking industry, but also of regulators. The other risks, of course, are just as important, but these were the top three risks. Okay, we move on to the next slide. And here comes the creative part. Most of it is common sense, of course. It doesn't make it any easier because it's common sense, because obviously when you are trying to promote change, you will find a lot of resistance. You will find a lot of people who can tell you this cannot be done, and that is the time when you need to have the moral courage to push ahead with implementing the things that are needed in order for your organization to reach its objectives. I think we have all realized how the crisis management function has become so very important. We all have experiences of disaster recovery plans. Very few organizations have had to deal with these disaster recovery plans on a real life situation. There were some who had to. I like to mention the experience that TSB Bank in the UK went through 2 years ago when they tried to upgrade their IT system. And it was a complete disaster, and the bank is still suffering from that situation where it was obvious that the disaster recovery plans were not up to scratch, and therefore I think all banks now realize how important it is to be prepared for a real disaster, and I think this pandemic has given us a good case study of how to deal with it. I think that we will also see an acceleration of digitalization of services. Last week I was in Valletta, and I saw about 100 people queuing in front of one of the offices of our banks, and I don't think that our customers will tolerate the situation forever. Of course, the situation is not just to press a button and ask all clients to get service online, because there is a whole generation of people who are probably beyond learning how to use digital delivery channels. And I think banks have an obligation to train all those who are able and willing to be trained in using digitalized service, and to provide services for those who unfortunately are beyond learning to use digitalized services. I know that some banks, for instance, abroad, are dedicating opening hours in their physical delivery channels in their branches purely for senior citizens, so that they can get the service that they need in particular times when the bank will only be open for those particular segment of clients. Refine capital, liquidity, and credit management models. As I said, I have not seen a risk model and a credit management model that was predicting a collapse in the economy or the kind of liquidity challenges that some banks were facing as a result of the pandemic. All of a sudden, some businesses completely relied on the banks. Thankfully, many governments put in safety nets to make sure that these businesses continue to be in business. I think the big challenge now will be to decide which of these businesses are affected purely by the pandemic and therefore have a liquidity challenge, rather than businesses who are living on the fringe of liability before the pandemic and therefore are probably facing more of a solvency issue. I think it will promote moral hazard if we don't make a distinction between these two very different situations. Re-engineering was very popular in all businesses in the 90s. I remember this being the flavor of the decade in the 90s. I think it will have to become the flavor again in the next decade, where banks will have to look at the way they operate and see how they can slimline their operations. First of all, to save costs. Secondly, to protect their employees from risks if this pandemic, unfortunately, were to prolong for longer than is desirable. And I think every business from time to time has to go through this. It is one of the most painful operations in my experience. I have been through this experience of re-engineering in different organizations, and the resistance that you find from all sectors is difficult to imagine. I can assure you it is something that is very real, and that top people in the organization need a lot of moral leadership to be able to implement the changes that are needed. We view investment service portfolio to meet challenges of prolonged low interest rate scenario. I think this is a challenge where many banks are facing because obviously the low interest rate scenario means that we cannot really offer many interesting opportunities for our clients to improve their yield prospects on their investment. Recalibrate brick and mortar delivery strategy. We've spoken about this. I'll move on because time is pressing. Next slide, please. It is a challenging agenda, as I said. I think any major crisis is challenging in itself, and it always brings about change, whether it will be radical change or whether it will be incremental change. We still have to see. The positive things that are working for us at the moment is that financial system is far more resilient than it was a decade ago, thanks to the changes that have been made in regulation. Not all regulation has been, of course, equally successful. Consumers are better prepared. As I said, that people are beginning to be more careful about the way they spend money, and this, I think, predated COVID. The economy of Europe is still relatively strong. It may not be growing at the rate that many business leaders and political leaders would like it to change, but it is still relatively strong. And therefore, the damage is more contained, especially as this time around, governments have used all the fiscal tools that they have at their disposal to make sure that we don't see the downturn that we saw in 2010, for instance, when governments had to rescue banks. Okay, next slide. Changes needed for banks' business models. Adjust risk models to make them fit and proper, mitigate risks of poor business decisions. I think the conduct risk will always continue to be one of the major risks. I think what this has done is aware of the risks of bad decisions and how much more focused we need to be on our risk models. I think, as I said earlier, nobody was really expecting such a big downturn from something that last happened a century ago. So I think that in future, we may need to build in these extreme scenarios into our business models. Operating models will have to focus more on adjustments, the way that we operate. Cost controls will become fashionable again and more fashionable than, and innovation. We have to broaden our horizons, move out of our comfort zones to make sure that the way we operate is really effective. Delivery channels, we have said enough about this, that there is a big challenge for banks. I think smaller banks and medium-sized banks will be the most effective. I think no bank can continue to expect to develop its own technology platforms without collaboration with fintech companies and with IT companies. I think the technology has become so complex that in future we will be seeing alliances between banks. As I said, smaller banks and medium-sized banks will have a high entry level because investment in this activity is very expensive, and you can only make it feasible if you team up with technology. I think, as I said earlier, customer focus will become a reality more than a slogan in the coming decade. I think people will expect more from the banks, and customer service and advice especially. Plain vanilla banking services may not be all that much in demand, I think we will need to study more the particular situations of our clients and how we can help. And obviously, better governance and better ways of addressing the revenue compression coming from the various factors discussed. Okay, we move on to the next regulatory challenges. Low interest rates may have helped the economy to avoid falling into a depression in the last 10 years, but I think it has also created a lot of collateral damage, and I think this needs to be addressed because banks and insurance companies have been the worst hit by this low negative rate interest rate scenario. What is more worrying, perhaps, is the fact that nobody is predicting that this will end anytime soon. One of my favorite concerns is credit reallocation towards non-banks. A lot of progress has been made in the last decade in regulating banks, but I think that all we have done is shift risk onto other credit providers, and I'm here referring to stock exchanges, where companies can borrow money directly from very often retail consumers who may not understand the complications of the kind of investments they are making and the risks they are taking. I think that we will see regulation now extending in other sectors as intensely as it was in the banking sector in the last decade. The digital economy and viability of banks and business models. Unfortunately, Europe is overbanked in the sense that there is a lot of bank fragmentation. There are a lot of small banks, countries like Italy, for instance, and even France and Germany. And I think that this kind of business models where small banks continue to exist without entering into some kind of alliance with larger banks may not be viable in the future. I think regulators will be on the watch out to make sure that the smaller banks, which of course have a very important role in many economies, I mentioned again Italy and Germany, where small banks traditionally are the backbone of small businesses, will meet the challenges of providing digital services successfully. And again, there has to be a brokerage or a marriage between big tech and digitalization. I think the big tech companies are the ones that can provide the platforms that are needed for the digitization of services. No bank can expect to provide these services in-house anymore. We move on. There was a quote, new regulation to address, I think I mentioned this, operational resilience. I think operations will once again become a very focused area of management. Laser focus on cybersecurity. Unfortunately, scammers are sometimes ahead of regulators and the bank IT functions in finding ways of stealing money from people's accounts and banks' accounts. And I think that banks will need to beef up their resources here. And short-term regulatory relief. We have seen this happening already. I don't think it will have to go on forever because obviously the kind of concessions that regulators are giving to banks at the moment can only be sustained in the short term. The last, this is a critical comment on the way that regulation has developed in the last decade. There have been many positive changes, but there has also been some missed opportunities to make regulation more effective. First of all, this was the real stress test that banks have undergone. If I read correctly, the European Central Bank and the European Banking Authority have suspended the stress tests for 2010-21. A good opportunity to review what these stress tests should look like after the experience we have been through in this last few months. And of course, the banking regulation will have to look about look at the pro-cyclicality regulations that characterize Basel III, because this can make a recession even more profound than originally intended. By this I mean that when there is a downturn in the economy, rather than force banks to increase their capital and to be more active in declaring doubtful debts and in providing these debts, we should be finding counter-cyclical measures so that in a time of recession as we are in the moment, rather than having to make emergency regulations to cater for this, we will need to prepare for downturns ahead of time. I think there will always be an emphasis on banks having sufficient capital levels, but not to the extent maybe that is being envisaged at the moment. That was the end of my presentation. I would welcome any questions which anyone may have.
So let's now turn this off. And at the moment, nobody's got their hand raised. I would ask anyone who is interested in asking a question to just raise their hand or send me a message in the chat. John, I was particularly interested in a couple of points. Perhaps I can start the questions. First of all, what we were looking at was not just the consumer buying and saving behavior, which was obviously a very, very important point for banks, but also for all businesses, but also banks' business models. One of the things, I worked for a leading bank some years ago, as you know, and one of the things that we had been talking about was the move from bricks and mortar to online services, something you have stressed a great deal in your presentation. The American Bankers Association, you referred to the study in one of your slides, said the purpose of the branch has been from transactional to consultative. As you said, this is not something that has happened because of COVID, but happened beforehand. However, what is going to be the impact of that on bank employment?
First of all, I think that bank training will have to change. I think that even our tertiary education, that is the university, needs to put more emphasis on the importance of meeting customer requirements. And as you said, and as being emphasized, customers may expect a higher level of service from banks than simply depositing their money or buying government bonds or buying corporate bonds. They will need, first of all, there are developments also in consumer protection regulation, where we are being reminded constantly that we owe a responsibility to advise our clients and to take their long-term interests in consideration rather than our short-term targets. There was a phase, I remember in my career about 20 years ago, when the flavor of the year was that you should now consider yourselves as salesmen rather than bankers. Of course, the sales culture was predominant for a decade in the beginning of this millennium. I think now we are focusing more on the importance of putting our clients first. And I think that clients' interests should be put in front of everything. And I think that our clients will also expect to have a choice whether to go to a branch, to have a face-to-face meeting, or to use one of the video conferencing facilities that are so easily available today to discuss a particular issue with their branch manager or whoever the relationship officer is. As I said, there are different generations who have different needs. And I think we must not ignore the needs of the older generations, where training may be not as a feasible solution as some people need to.
We have a question from Alan Cassar, the Chief Officer for Financial Stability at the bank. Alan, over to you.
Good morning. Yes, I have a question on your reference to the big tech companies. Obviously, it's point that it's a very important aspect of what's happening in the industry. We know that banks are facing more and more challenges from these companies, the fintechs and the big techs. And we also know that their business models are quite different from what the banks used to do, in the sense that they are less focused on charging for the services that they give, and they are more about monetizing the information that the activity of these services generate. How could the banks react to this sort of change in the models of how you charge your clients?
As I said in my presentation, I don't think that it will be a good idea for banks to set up their own IT platforms. I remember a time when the IT services in the bank was considered like one of the other services, like the maintenance of premises and so on. Then we moved on to a phase where IT became a strategic issue. And we saw heads of IT, chief information officers forming part of banks and board directors, at least some of them, becoming more acquainted with the IT industry. So IT is now in the mainstream in banking. And I think that although fintech companies pose a challenge to banks, I think the solution is not to fight these IT companies by trying to emulate them, but by making alliances. The transition from traditional banking to the banking of the future will not be sudden. It will be steady, and it will keep increasing. But I think the strategy I would advise to a bank at the moment is to identify who the leaders are in providing technology services that can support our clients and build alliances. Because at the moment there are too many small banks and medium-sized banks that cannot afford to invest the kind of money that is needed to provide a delivery channel which is equally good in digital services as well as in traditional physical services to our branches.
We have a question from our librarian, Manuel Cassar.
Yes, first of all, thank you so much for your presentation. Basically, my question is, you know much more better than me that banking is very much related on trust. In the last years, we have seen what I call the impersonification of of banking services, in the sense that people are asked, to deal with a machine or with an ATM rather than, face-to-face contact with the bankers. Is there any signs that people are losing, or this impersonification of the services having on trust that people have on the banks? And my other question is about savings. It seems to me that if you look at savings from a carrot and stick aspect, it's more now on the stick, in the sense you save for a rainy day rather than to get something out of your of saving. How does this impact on money as a storage of value? I mean, people just put money in the bank just in case something happens, or because they want to keep their savings there rather than invest them in property or something else. Thanks.
To answer your first question, yes, trust is important. I think banking thrives on trust. Unfortunately, as I said during my presentation, banks never got a very good media. There are always complaints about banks. They were perceived to be money-making machines in the past, and when they find themselves in trouble because of misbehaving, as it is euphemistically called, they expect taxpayers to bail them out. This is something we need to address, because obviously, like every service company, We can only survive as an industry, at least the traditional part of the industry, if we put our customers first, not just in our slogans and in our mission statements, but also in reality. With regards to the services provided by banks, there are some simple services. I think, for instance, an ATM is the most basic service. And I think that a good part of our population today, of our society, have learned how to use ATMs without major heartaches. Maybe we need more ATMs, although the trend in many countries now is to remove their ATMs. I've just read this morning that the Royal Post in England is closing about a third of their ATMs because they are non-profit making. I think that would be a bad development, especially in the local environment. I think ATMs will continue to be very popular because that is the most common use of banking services, although obviously it is not the only use. Other services, we can be creative. As I said earlier, we need to train our staff to communicate with our clients rather than in physical face-to-face meetings in our branches, where they probably have to wait in a queue to get served. They can communicate via video conferencing. And this is an important consideration. I think banks also need to revamp their websites to make more information available. And some banks internationally have done this very successfully. And again, there is no one simple solution. I don't think that having a completely digitalized banking service is the solution. At least in the medium term, there has to be a dual approach, a two-pronged approach to the provision of service. To move on to your second question, yes, at the moment, people with money who are saving money don't have much choice where to invest that money. Unfortunately, some may be tempted to go for riskier investment, thinking or not understanding exactly what kind of damage they can do to their wealth if things go wrong. It's all right for governments to provide safety nets in times of crisis like we are in the moment, but I think it will be imprudent to rely on these safety nets being there forever, because they will not be there forever. So, yes, at the moment, I would say that preserving capital would be the main aim. And it is very challenging for the investment departments of banks to find ways where they can offer products and services to their investing clients that are safe and at the same time give some kind of return. This is the challenge that all leaders of our investment sections of our banks are facing. This phase will be over. I think low interest rates will have to come to an end sooner than later. And I see, although it will be painful, I see no harm in people at the moment focusing on preserving their capital and buying investment products that are low risk if their risk tolerance, of course, doesn't permit them to take higher risks, in order to have better opportunities when situation changes and the low interest rate scenario will be behind us.
Thank you, John. Of course, the payment habits is something which is regularly monitored by the central bank. There are actually 400 ATMs on the island, but of course, one of the points made by our Chief Officer for Banking, Desmond Gutt, a few months ago, back in May, was that this is actually limited by the fact that there are, if we're trying to encourage people to get away from the more traditional forms of payment, there are only 16,000 points of sale. So do you think that some of the drives by utility companies over COVID, for example, to go for direct debit, the way that the central bank itself has changed directives to try and encourage digital credit, for example, with all the social security payments and so on. Do you think that these changes will be permanent, John? And then we have a couple of questions from the chat I'd like to pass on to you.
Yes, very briefly, I think ATMs will be a feature. What I worry about is if banks suddenly start to copy the model which is being applied by some banks in the UK of reducing the number of ATMs. I think what we can do is more rationalization. Sometimes you find two ATMs of two competing banks within 10 meters of each other. I think that better communication, better cooperation between banks can reduce the cost and also serve clients better. Yes, direct debits are important. I think many businesses are encouraging their clients to sign in on direct debits by giving them a discount. And I think that is the way that we should be going forward in the future.
Let's have a couple of questions from the chat. Robert Suban asked, do you think digitalization is going to be an opportunity for banks to reduce their costs and increase their profit margins? And do you think the trend in digitalization will have to be slower in Malta, given the older population and the fact, of course, that we don't want to upset them?
Digitalization is partly driven by the importance of reducing costs, and there is no second way about it. It is also driven, however, by convenience. I think during this pandemic, we have all learned how to procure services online. Even people of my generation and perhaps older than me have learned to even buy a washing machine if need be online without going to a showroom and spending half an hour looking at whatever washing machine and doing your research on the internet. So yes, I think digitalization is being moved both by the importance of reducing costs and also by the importance of convenience that customers are looking for. With regards to the second part of the question, yes, we have an aging population, and that's why I emphasize that the importance of having a two-pronged approach to digitalization. I don't think it is fair to exclude a big section of our society, of our community, from banking simply because they are past the stage where they can learn how to use an ATM or how to do online, pay the bills online. So I think banks have to be creative here and perhaps imitate the models that are being applied in some countries where they dedicated part of their opening times for the older adults so that they can get their services in the way that they are used to getting. Of course, the younger generations will soon take over, and it will be easier to convince them to use digital services.
We also have a question from Keith Gregg, who's asked, if a vaccine is announced by the end of the year, the pandemic is expected to continue in 2021. It will take time for supplies to be provided on a worldwide scale. This is expected to continue to drive saving higher, with yields dropping. What alternative products should the bank introduce to promote financial investment?
Yes, I agree that the predictions about how long the pandemic may last are very confusing. Even medical experts, never mind politicians, are expressing very different views about when we should expect for some kind of normality to return. So yes, the challenges will be there. I think we have to be very careful to protect consumers, because I don't think that in a low interest rate scenario, you can really come out with a fantastic product that will give you a 6% return without this being linked to a much higher risk than many people with a low risk tolerance level can support. So I think here regulators need to be careful to make sure that, first of all, consumers are protected in the sense that whatever an investment services, not just by banks, but by investment brokers and all the community that provides these kinds of services, are clearly marked as far as the risk grading is concerned. It is important that, first of all, we protect consumers, and secondly, that we have a level playing field in the sense that banks cannot take the kind of risks which a broker who may not be following the rules of consumer protection and the regulations about disclosure of risk to his clients may follow. So I think this will be very challenging for regulators to make sure that we don't expose. But I don't envisage any silver bullet that will solve the problem of those investors who are seeking yield without necessarily wanting to increase their risk appetite. This is one of those things that we have to see how it evolves. Hopefully when the low risk scenario is over, we will be able to come up with more interesting products.
We also have a question from René Saliba at the Malta Development Bank. René, would you like to go ahead?
Yeah, thank you. So thank you very much, John, for your very excellent presentation. You've focused a lot on consumers and retail services, possibly in terms of banking services. But if I may perhaps focus a little bit more on the credit side of banking services. We've seen 10, 15, 12 years ago, the impact of the international financial crisis was obviously a very, very strong de-risking approach by the banks. And in Malta, not just Malta, but in various countries, we saw that whereas previously there was a very strong correlation between the rate of growth of the economy and the rate of growth of domestic credit, in the case of a number of years, we saw actually a complete decoupling of these two variables, with the economic recovery subsequent to the crisis being coinciding with a period of actual absolute cuts and decline in the level of domestic credit, something which for Malta was very, very new. Previously, credit always grew in line with economic activity, but there was a period when actually the economy was expanding and bank credit was contracting. The central banking field tried to address that issue across the EU and elsewhere through the quantitative easing, easy monetary policy, central banks lending at zero interest rates to banks for on lending to the real economy. But notwithstanding that, we've been seeing actually an increasing financial disintermediation. So basically, if we look at how much money was raised through on the local capital market, which traditionally has been quite thin, the amount of IPOs and bond issuance in recent years has outpaced the amount of new domestic credit, which obviously means that banks have got much more excess liquidity, very often paying a negative interest rate. So obviously, COVID has not helped to boost the risk appetite of banks. So once the government safety net eventually will be over, once the government guarantee schemes will be over, and banks have to really face the credit risk once again on their own. What do you see the outlook for bank credit? What do you see the outlook for businesses and consumers in general with regard to access to financing?
Yes, this is a very interesting point that René has raised. First of all, I think that it is reasonable to expect that the stress on the economy and therefore on businesses as a result of COVID will stretch beyond next year and probably even the year after. So yes, there will be some businesses who will be penalized as a result of the pandemic. I attribute the decoupling between the real economy and the credit facilities provided by banks to the evolvement of regulation in this last decade. Unfortunately, regulation has put more emphasis on pro-cyclical measures, so that when the economy was in distress, as it is at the moment, banks were expected to create more provisions, therefore affecting the profitability, increase their capital, therefore affecting their profitability. And obviously, the first target that bank boards would adopt would be to the risk, and therefore to take or make the situation of struggling businesses even worse. This is happening everywhere, and I think that this is one of the issues that regulation has to address. It is no use suspending regulations as has happened with the shelving of the Stability and Growth Pact for governments when things are really bad. We should try to avoid the situation from happening. What worries me most is that while regulation on banking has been tightening in the last 10 years, regulation on private issues of debt from stock exchanges has not. And I think that with all their weaknesses, banks have a better risk assessment experience than most investment brokers and also their clients. So the risk that we may be running is, and here I speak generally on a European level, is that because investors are seeking yield, they are buying investments that normally they would not buy, were it not for the very low interest that they earn from their bank deposits. So this is one of the challenges that banks in consultation with regulators should be discussing, and I'm sure it is one of the issues that is being discussed at the European Central Bank level, because we don't want to sow the seed of another major financial crisis in a decade's time, because that is a risk that we cannot exclude at the moment.
Thank you, Renee. Can I just throw something out there, John? I'm reading a book by Yuval Harari at the moment, where he talks about artificial intelligence and the impact it could have on the technology of banking. He actually thinks that artificial intelligence would do a better job than a human banker when it comes to assessing risks. With the pressure you have now on money laundering, on return on investment, on reducing your NPLs, what do you think? Do you think we will find robots doing this, bots doing this work for us?
Yes, I think artificial intelligence applications are one of the more useful developments in technology. There is no doubt that artificial intelligence will play an important role in our industry. I don't see it happening in the next decade. Probably we still need to overcome more fundamental changes, or to implement more fundamental changes before we come to that stage. But you are right. I think artificial intelligence will be one of the technologies that will affect customer service. It will affect the labor market, because obviously when you get machines to take decisions, or rather suggest decisions that normally used to be taken by humans, then obviously that is going to cause disruption. So yes, artificial intelligence, unlike some other developments in technology, which I still need to be convinced about, I think will be a main feature, and it is good that we start to prepare ourselves for the implications of this on our business. But at the moment, I see more urgent applications of technology in providing services.
Well, we started with in 2019 trying to predict where 2020 would be, and of course we were able to see how wrong we are. And I think it would be really interesting in 10 years' time to listen to this recording again to find out how accurate we were with regards to how permanent the changes were, to the adoptions of new payment habits, the new investment habits, new spending habits, and everything else. You've certainly given us an awful lot to think about. Thank you very much, John, for spending this time with us. May I just remind you all that the European Central Bank is at the moment undergoing a strategic review, and it is looking at a number of different issues, not just monetary policy, but also quantitative easing, climate change, costs of housing and everything else. National central banks are also playing their part in their review, and we will be having our own public event on the 14th of December. We would encourage everyone who is following this to follow us on social media. We are on LinkedIn, and we also have a Central Bank of Malta events page on Facebook, as well as Twitter, where we advertise all the events such as these lectures and so on that we have coming up. It's also, of course, very important for us to point out that the library organises a number of these events on a very wide range of topics. And the library has its own dedicated section on the website where you can find out all about the services. It has over 12,000 publications, a number of digital publications, a number of online databases, magazines, etc., which are all at the disposal of our researchers, academics, students, etc. You can subscribe online and you'll find a lot of information there. For the moment, I think that's all. Thank you to all of you for attending, and we look forward to meeting up in a few years' time to look back and see how right or wrong we were. Let's hope there's not too much that we haven't exactly anticipated. John, thank you, and thank you to all of you, and of course to the communications department team for helping with all the recording and participation of on this webinar. Have a good week.
Thank you very much. Thanks.